Hello and welcome to today's webinar, which is a session where we'll be looking at investment in retirement. This is a presentation we did up and down the UK during the end of September. So sorry you couldn't make it to that, and welcome along today. A few bits of admin just before we get stuck into the session itself. You can ask questions at any time during the presentation. There ought to be a little question box on the right-hand side of your screen. You can pop your questions in there. The session is being moderated, and so we'll get back to you as soon as we can on there. Any questions we're not able to answer immediately, we'll come back to you later in the day. Similarly, if you've got any technical problems, sound or screen, anything you've got issues there, pop them in the question box and we'll endeavour to get them sorted out whilst you're online. It's a CPD event, probably why you're on here, to be honest. And so we'll send an email out at the end of the session with your CPD certificate. You do unfortunately have to watch until the very end to get your certificate. And also on that email, you'll get a feedback form. So if you can fill that in for us, all feedback is greatly appreciated. There will be a recording available on Investcentre in the next couple of days. So if you're not able to stay for the full session, you can pop back on later on. And it goes without saying that this webinar is for professional advisor use only. Okay, then let's get stuck into the session. We're talking about investment in retirement, and so if you do have clients or even yourself, you're coming close to retirement or indeed in retirement, you will have been born probably in the 1950s or early 1960s. And we're better to start and provide a little analogy of what happens in retirement than to look at some of the events that were taking place in the 1960s. 1961, the 12th of April 1961, Yuri Gagarin pops up above the Kármán line for the first time in history, the first human being to leave the planet. 1961, and within 7 weeks, President Kennedy, who looks at what the Russians are doing, panics and says, "Okay, we need to get our own astronauts into space here." They spent, or he applies for $9 billion. Remember, this is 1961 money, so an awful lot of money, in order to set this great mission of sending a human being, landing them on the moon, and returning them safely back down to Earth. And of course, we'll all know that 20th of July 1969, that's exactly what we did: sent the man onto the moon, returned them safely back down to Earth. That provides a nice analogy for what it is we do as investors as we go through our early stages of investment. We got too much money, which by definition all savers have. We put that money aside and we invest it into suitable investment strategies, hopefully with the intention of not just the money that you put aside, but the investment growth over a period of time provide you with a nice nest egg from which to live off in retirement. Now, some statistics on space travel fatalities, and I warn you, there will be a number of deaths in today's presentation. There are actually only 18 people who've ever died during the course of space travel. We'll all remember 1986, the space shuttle Challenger disaster, where 7 people unfortunately exploded literally on our TV screens. But actually, that's the only 7 people who've died in space on the way up. All the other 11 fatalities in space have happened on the way down. And actually, if you apply that metaphor to what we do in our industry, the easy part, if you want to call it that, is going up. It's when you've got too much money and you're saving that aside and investing it nicely. The hard part is how to ensure that we live off this once we're in retirement, and this is at the point where we don't have too much money and you're now living off your investments for potentially the rest of your life. Well, the bad news is the FCA believe that they've got a solution to this in the form of investment pathways. Now, at AJ Bell, we were in regular dialogue with the FCA, and we went into the FCA to talk to them about their investment pathways just a couple of weeks ago. And these are the 3 pathways that they suggest investors and retirees ought to be considering when it comes to taking their retirement. And you see the 3 pathways on there. We were not overly happy with their investment pathways. Certainly, as dealing with a business that deals with professional advisors such as yourselves on a regular basis, well, first of all, the second one there, I want to take all of my money over a short period of time. To us, that's not even an investment pathway. If you, I guarantee that if a customer came to you in retirement and said, I intend to spend all of my retirement funds over the next year or two, you wouldn't probably take them on as a customer, and you obviously advise them to do something different than that. What you certainly wouldn't do is you wouldn't put them into an investment product where, as we know, investment ought to be a long-term endeavor. And so anyone who wants to take their money over a short period of time really shouldn't be investing anyway. So the middle one there to us isn't even an investment pathway. What I also guarantee is if a customer came to you and said something vague like, I want to take an income in retirement, or I want to keep some of my money invested, but I might want to dip into it occasionally, you certainly wouldn't pack away your folder and say, okay, thank you very much, that's the fact find over and done with. I know exactly what investment products you need. It will be the start of a conversation. It would be a start of a conversation which would look at people's health, their lifestyle, other income sources, other assets that they have available. So we think it's incredulous, actually, that you can answer or basically tick one of these three options and suddenly your investment pathway in retirement is all set. So that was the message we gave to the FCA. And what it highlights, actually, in our opinion, is that actually more people ought to be taking professional advice when it comes to this key important decision of how to invest when it comes to retirement. So if you take a look at some of the statistics on who actually takes advice in the UK, it's actually a small proportion of the UK population. There are 55 million adults in the UK, and the FCA went out and surveyed thousands of those adults in the Financial Lives survey for 2017. And what you can see there is actually only 6% of the UK adult population have taken financial advice in the past 12 months. Now that amounts to a lot of people. That's 3.2 million people. But when you can also consider that there are 14,500 financial practices in the UK and only 26,000 financial advisors in the UK, that means that on average, you guys are dealing with probably about 125 to 130 clients on an annual basis. And indeed, some of you will be dealing with many more. One of the key feedbacks we get when we speak to advisors is, I'm actually just really too busy. So the 6% of the UK adult population that do take advice, there's actually 25% of the population, nearly 13 million people, who didn't take advice in the past 12 months, but under the FCA's criteria, probably ought to have taken advice given the complexity of their financial arrangements. And if you want some data on why they didn't take advice, the two main reasons are around price and also around trust. So as an industry, we ought to be lowering our costs, and we also need to be acting in an ethical way in order to ensure that people, those 13 million people who could have taken advice but decided not to, if we want to grow our industry, one of the ways we can do that is lower cost and also increase our trust. But if we take a look at that 3.2 million people and delve a little deeper, you'll know this because these are the people that you speak to on a day-to-day basis. They are not representative of the rest of the UK population. So we can see on there, they're far more statistically likely to be in a relationship, in marriage. You're probably also more likely to be dealing with the male of that couple rather than the female of that couple. And then also, if you take a look towards the bottom of the slide there, you see that they are statistically much more likely to be either in retirement or very close to retirement. People who take financial advice tend to be at that stage of life, either in retirement or coming close to retirement. And so it's interesting, you take a look at those figures there, about a third of the advice population are already in retirement. And if we take a look at the figures, another 28% are likely to be in retirement in the next 10 years. It's interesting, therefore, that a lot of people in the advice community have spent a lot of time over the past 6 or 7 years perfecting their centralized investment proposition, which is how to invest people's money as they go through the accumulation phase of their investment journey. But when we speak to advisors, probably only around a third of advisors have spent any time putting together a centralized retirement proposition. And that's not just about choosing the investment products that you use in retirement. It's about your cash flow planning software. It's about which ATR provider you may or may not use for retirees. It's about really understanding that people are in a completely different phase of their life when they go into retirement, in contrast with the phase of life they have when they're in the accumulation phase. So it just begs the question, what are the sorts of things that we ought to be considering when it comes to centralized retirement propositions? And that's what we'll talk about for the remainder of this webinar. The key risk, of course, when it comes to investing in retirement is the customer and the client outlives their money. And that's a function of a whole bunch of things, yes, including investment returns, but things like longevity, lifestyle, care, and just general life events also need to be taken into account. And so before we get into the investment part of the webinar, it's just worthwhile putting some of those other risks into context. First one is on longevity. Now, there was data out very recently. We're recording this at the end of September. Data out in the last week of September showed that in the UK, life expectancy did not increase at all, which has been consistent with some of the data we've seen over the past 3 or 4 years. It seems that some of the big gains that we've seen in life expectancy over the past decade are now starting to peter out. And of course, the government and various agencies are trying to decipher why that is. But if you're to retire today at 65, life expectancy for male and female is both in both cases around 20 years. So statistically, and I did warn you there'd be some deaths today, statistically, if you retire at 65, you'll be dead within 20 years. So it's interesting when you think of your sustainable withdrawal rates, and we're all familiar, I'm sure, with the 4% rule, i.e., that if you take 4% of your initial pension pot and grow that income in line with inflation, all historical tests show that if you start with that 4% sustainable withdrawal rate, you never run out of money. That money will last you until the end of your life. But if you now start to look at this in a statistical sense, if you're only taking 4% of your money over 20 years, that says that you probably end up with, even if your investment pot just kept in pace in line with inflation, you'll probably end up with about 20% of your original pension pot left over when it comes to the unfortunate demise of whoever you are. So, and when we look at this in other areas, well, what we're tending to find is that people are being really cautious when it comes to taking income in retirement. There seems to be a fear that the money will run out, and people, as we'll see in a second, are acting very cautiously as a consequence of this. We also, let's take a look at the lifestyle element of this, and again, take this in the context of maybe some of the cash flow tools that are out there. A lot of the cash flow tools that are out there start with an initial income withdrawal at retirement, and they grow that income withdrawal in line with inflation ad infinitum. Now, that's just not consistent with what we see in the real world. Here's data from the Office for National Statistics, and you can see there we've organized weekly expenditure by age cohort. So people in the 30s until the mid 60s tend to spend on average around £600 a week. But once they go into retirement, this average weekly expenditure drops off significantly once they get past 75. The big one when you retire is you tend to spend significantly less on transport. But once you get into the 75 and above area, on just about every category of expenditure, what you're spending actually drops significantly. So that when you're 75 plus, you're spending roughly half of what you spend when you're in your 50s and early 60s. And again, what that demonstrates to us is if you are taking just 4% and you're expecting to grow that income in line with inflation, that's maybe not the correct assumption to be making when it comes to retirement. You put all of this together, and the Institute for Fiscal Studies have actually been able to demonstrate, and it's a horrible chart, this, so I'll summarize it for you. They've been able to demonstrate that over the people's retirement years, net financial wealth isn't being drawn down anywhere near as aggressively as perhaps they ought to if people want to enjoy uh, things that they've always wanted to do in early retirement, and also potentially not being drawn down aggressively enough if people want to live comfortably in later life. The statistics show here that between the ages of 70 and 90, on average, people are drawing down just over 30% of their pension pots. Now, there may be good reason for that in terms of inheritance tax planning considerations and assets that are available to them elsewhere. But the data from the IFS and subsequent surveys have shown that people are worried about longevity, and they're also worried about long-term healthcare and the cost of that. Now, when it comes to insuring against longevity, I appreciate, that very few people buy annuities these days, but maybe there is a place for annuities when it comes to retirement planning, even if only to cover basic non-discretionary expenditure, or even a deferred annuity in order to insure against the risk of longevity. But when it comes to long-term healthcare, it's not possible to insure yourself against this. And so what we're seeing on average is people are self-insuring against that risk by being quite frugal when it comes to spending in retirement. And so just before we go into the investment bits and pieces, I just want to put some of that in context as well. There are just over 11 million people in the UK over the age of 65. And that figure will grow significantly in coming years, which is why there is a pinch point within the care industry about, can we recruit enough carers? Is there enough provision for long-term healthcare as people age? That's not a function of prevalence of more, a proportion of people needing long-term healthcare. That's a function of that there are simply more and more people over the age of 65, and because people are living longer, there will be an increasing number of people who require long-term healthcare. Actually, the statistics from Age UK show us that there are only just over 3.5% of the UK over 65 population who are actually in long-term healthcare. And then also Age UK go on to show us that of the people who tend to go into long-term healthcare, and I did warn you that people would die in this presentation, approximately just over 75% of people who go into long-term healthcare will actually be dead within 2 years. And so this idea of long-term healthcare, people requiring healthcare for numbers of years in the event that they do unfortunately require long-term healthcare, just again simply doesn't stack up with the data. Statistically, people who go into long-term healthcare unfortunately tend to pass away on average within about 400 days. And so the idea that you're saving 60-70% of your retirement pot in order to self-insure against the risk of long-term healthcare suggests that people are maybe over-insuring themselves for that risk and foregoing opportunities in early retirement to do things that they've always wanted to do, or possibly living an uncomfortable lifestyle in later retirement. Actually, the worst thing you can do if you want to blow your pension pot in retirement is get divorced. And again, if you listen to the press will tell you that the number of people over the age of 60 going through divorce is rising significantly. But again, that's not a function of prevalence. That's a function of the number of people over the age of 60 is increasing rapidly, and therefore it's not a function of prevalence. It's just a numerical weight of argument. Actually, you'll see from the slide there, the probability of getting divorced over the age of 60 is actually just over 2%, and that figure has been remarkably stable over the past decade. It will be a financial headache if you are unfortunate to go through that experience, but again, it's a risk that is perhaps being overplayed by the press, and when they look at the numbers, whereas we ought to be looking at the prevalence, not the numbers. Which brings me on to investment returns, which is where the risks associated now start to multiply. Anyone listening to this webinar had no influence whatsoever over the day that they were born. And therefore, you've got no influence whatsoever over the day that you turn 65. You do have some influence over the age you actually decide to retire, but the age at which you're eligible for retirement is something that you got no control over. So it really is pot luck on the day that you decide to retire. You've got no control over that date, nor have you any control over investment conditions on the day that you retire. So what we put on here is an illustration of how different that can be depending on the date of retirement and investment considerations at that time. It's an illustration where we start with £100,000 and we take 6%, so £6,000 each year, and we grow that £6,000 in line with inflation over the course of the illustration. Now, if you were fortunate enough to retire in 1988, you could have taken that 6% year after year from your £100,000, and 10 years later, investment considerations were so benign for you that even 10 years later, your retirement pot hadn't just stayed level, you'd actually added another 54% to your retirement pot, despite the fact that you'd taken 6% and grown that income in line with inflation over the time frame. Contrast that with someone who comes along 10 years later and retires in 1998. Now they get off to a nice start. They hit the late 90s investment bubble. They get the benefit of the dot-com boom in the early 2000s, but then they run into 9/11. They run into a slowdown in the global economy. They're hit by lower interest rates, which were held low for long, and you have a prolonged period of poor investment returns in the early 2000s. Now we know that investment markets subsequently recovered, in later years, but what you can see there is your investment pot doesn't recover because you've had that impact of poor investment returns in the early years, and you've been taking an increasing proportion of your money on an ongoing basis. So it highlights some of the key risks that you face when it comes to investment in a drawdown environment, which is sequence and risk. Particularly in the early years, if you're unfortunate enough to hit poor investment returns in the early years of your drawdown, that significantly impacts your outcome. It also shows the reverse of what happens when we go through the accumulation phase. In accumulation, whilst you put money aside, you actually don't really mind if markets go down from time to time because you're not drawing on that pot. And actually, when markets are falling while you go through the accumulation phase, whilst it might give you a couple of sleepless nights, what it does do is it allows you to invest at better opportunities, and so you get the benefits of pound cost averaging. In retirement, of course, and in drawdown scenarios, that happens in reverse. So if you're unfortunate to see poor market conditions and you're pulling money out of that pot, you get the reverse of that, which is commonly known as pound cost ravaging. And so the final thing, of course, is what is the sustainable withdrawal rate? Is it 4%? Is it 6%? What's the rate at which I can withdraw from my pot without exhausting my funds before I exhaust myself? And so those big three risks of sequencing risk, pound cost ravaging, and what's my sustainable withdrawal rate, the industry in various places has come up with different solutions to address them. So for sequencing, what we commonly see is this concept of bucketing, which I'll explain a bit more on the next slide. When it comes to pound cost ravaging, wouldn't it be nice if we could build in a market timing mechanism so that when markets perform strongly, we maybe top slice our investment portfolios, and so we're drawing down when market conditions are strong rather than being forced to draw down when market conditions are poor. And then when it comes to the sustainable withdrawal rate, one of the industry proposed solutions is maybe we can live off the natural income from our investment portfolio. So they're the three possible solutions that the industry seems to have come up with. But in our research, we've actually seen no one who's put all of those three solutions together in a single proposition. And so all I'm going to show on the next slide is just a possible solution which brings in the concept of bucketing, the concept of market timing, and the concept of natural income into a single strategy. And it may be something you might want to have a play around with in your own portfolios and discuss with your customers. So let's look at the investment solution. We'll read this slide from right to left, focusing on the important things, which of course is our customers. So we start with our customers who have their retirement pot, and they've decided, they've listened to the research. They've decided in conjunction with yourselves that 4% income will meet their lifestyle requirements, and they're comfortable that that means they'll have a sustainable withdrawal rate from their pension pot going forward. What we've done here is we've segregated the pension pot into 3 different buckets. The bucket furthest to the right is a cash-like reserve. It could actually even be cash or money market funds, short-dated government bonds, but it's a very low-risk portfolio. And the idea behind this is that we put the first 2.5 years worth of income safely away in a low-risk pocket. And so for the first 2 to 2.5 years, we're not drawing from our riskier investment portfolio. Therefore, we protect ourselves for the first couple of years against against that sequence and risk that we discussed earlier, which is that the worst thing that can happen in the early years of your drawdown phase is you're faced with poor market conditions. So this cash-like reserve effectively buffers us from the first couple of years of having to draw down in poor investment markets. Coming further to the left, we then segregate the risky assets of the portfolio into 2 proportions. One is a portfolio which generates a 4% income, but is a lower risk portfolio, probably a portfolio of bonds, maybe a bit of property, some equity income in there in small proportion, but it generates a 4% income and is designed to be relatively stable when it comes to capital. You're really looking to produce a 4% income and generate capital preservation. And then furthest left, you've got the risky bucket, which will be probably 0 bonds in this. We want this portfolio to not only the income, but the capital to grow in line with inflation. So this is going to be a portfolio of real assets, probably dominated by equities and properties, for example. Again, producing a 4% income, but where the income and the capital grows in line with inflation. So if we roll time forward a little bit, and for the first couple of years, the customers are drawing from the cash-like reserve, what we have elsewhere within the portfolio is the natural income from the 2 risky elements of the portfolio refills the cash-like reserve on an ongoing basis. And so even 2 years hence, that cash-like reserve has not been depleted down to 2%. The income from these portfolios has topped that cash-like bucket up to more like 8, 9, 10%. Going forward, and so we're constantly topping up that cash bucket in order to protect against the need to have to draw from our risky elements of the portfolio in poor market conditions. So the last thing to do is really just put a market timing mechanism in place so that when markets are not in poor conditions, but actually in really strong conditions, we've got a mechanism in place that de-risks the portfolio and takes advantage of those strong market conditions. So we've arbitrarily chosen a 47.5% rebalancing trigger here, so that if either of those 2 portfolios, the risky portfolio or the medium risk portfolio, perform exceptionally well, exceptionally strongly at any point in time, they will of course grow as a proportion of the overall portfolio. And if they were to trigger above 47.5%, that will be an opportunity to take advantage of those strong market conditions, top slice those portfolios, and de-risk the overall portfolio by bringing that little bit of a strong performance and banking that and bringing it back into the cash-like reserve. And so that investment solution provides you with a dynamic way of rebalancing your portfolio. It produces natural income from the risky assets to top up the cash-like reserve, and it uses the bucketing principle in order to bring the whole thing together and help customers understand and mentally account for what their retirement portfolio is doing for them on an ongoing basis. Your clients can rest happy that they know that they got their income requirement. We know from real world observations that actually the 4% income, if they're happy with that at the point of retirement, chances are in 10 years time, when they're in their mid to late 70s, that actually their spending requirements will have dropped significantly. And also you've got the flexibility of having this all available to you in your pension pot to ensure against the risk of long-term healthcare. So hopefully that's been of use. Hopefully it's been of interest. Obviously, we're required to put a bit of a disclaimer on there. So that's the end of today's session. If you have stuck with us all the way to the end, you've successfully received your CPD certificate. And if you do have any questions, please pop them on the question box towards the right there, and we'd be love to get back to you and give us your feedback. Thanks very much. That's enough from me.